Hi everyone, welcome to the channel. Today is the 28th of April 2025. It's a Monday, beginning of the week. So I've taken a long on GU, which is pound dollar forex pair. As far as the setup, I saw this pullback on pound dollar and I'm trying to trade it back to the Asian Open. It's a 1.6 hour trade. Sorry, maybe 1.5. Yes. And let's see what happens. Looks like we're going to get our first candle. Century to turn green. Let me turn on this countdown. So we've got 15 seconds for the close of this candle. And then that's a good sign. We're respecting this 1 minute channel over here. So if you go down to on the time frame, respecting this 1 minute channel over here, so aiming to take these highs, and then if, when that happens, there's a bigger chance of continuation to the upside. By the way, I have a very simplistic strategy, no SMCs, ICTs, and things like that. I don't use fancy terms like manipulation, order blocks, fair value gaps, whatever they say these days. You think institutional traders use those terminologies, and the biggest institutional traders I've read about, watched documentaries about, watched their interviews of, they don't trade like us retail traders. I think you knew that, but I don't think you know what I mean. They're long-term traders who make large-scale economic predictions rather than quick setup on a 30-minute chart or even a 4-hour chart. They make quarterly economic predictions, and based on that, they take their trades, which are almost all the time very long-term. People like Gary Stevenson have turned up on social media these days. Right, if you watch the Diary of a CEO, you know what I'm talking about. Gary Economics. He claims to be one of the best traders in the world, to have been Citibank's best trader of the year back in the day. But from the figures he gives, looks like there's not much weight behind that claim. I'm sure he was one of the best. But $2 million, I'm not sure. And if you watch Gary, people ask him about trading, how to get better trading, how to trade, how to learn trading, how did he trade. From what I've listened to him say, I think he understands very little of the way retail traders trade, of the way the intra-trading thing works outside the institutional. He has a very long-term economic perspective with his trades. Right? He might take a trade for 6 months, quarter of a year even. So he doesn't have this short-term perspective of where's your stop loss, where's your entry, and all of that, you know? Or there's order block, there's fair value gap, there's manipulation, or there's liquidity, or let's do this. They don't think like this. The institutional traders are all about it. The line between investing and trading is very thin for the institutional. They use these terms interchangeably at times. So it's almost like investing for them. But they call it a trading position. So it's very different. The average retail trader has no idea how an institutional trader thinks and sees the market. So we have, as we can see, the traders turned to our side. It's a nice bullish candle, 13 seconds till it closes. Looks like it's going to close with a healthy body, take these highs that I was talking about. So that respects the 1 minute channel, takes the highs. That looks good. Again, talking about my strategy, right? When you just start trading, you think strategy is very important. Of course, it's important, but then a new trader, a newbie, has a very different idea. I mean, they are searching for the holy grail, so to speak. They're searching for that strong strategy, for that perfect strategy that's going to give them 95%, 99%, 100% win rate, so they make all the money they want from the markets. And they think to find a strategy that works is going to be a real serendipity, a real feat that requires such focused pursuit, right? You can find loads of free strategies on YouTube that your trading mentor will charge you for, but there are lots and lots of traders on YouTube who will give away their strategies for free, because these people have spent a lot of time in the markets, behind their screens, on their charts. They understand that the strategy, having a strategy alone, doesn't do anything. When someone comes into trading with a psychology that is unprepared for the art of trading, that hasn't been through the tough periods, that hasn't experienced what it's like to take losses, stay in drawdown, to understand probability, to understand that it's all a probability game. It's a game of statistics and gathering data. To understand that every single trader loses. To understand that no one has a 100% winning strategy if they claim to have. They're bullshitting, because, well, if they did, they'd be quickly compounding their money into millions, tens of millions, hundreds of millions, and even billions. Yet, show me a billionaire that's trading in the retail space, right? So you can get strategies for free on YouTube, for free. They won't charge you, right? If you go to some of these big YouTube channels in the trading space, I think most of those guys are showing their strategy for free. Yes, they have mentorship, but mentorships are not for the strategy. Mentorships are for trade management, psychology, a daily chart analysis, knowing what to do once you've taken the entry, knowing the mechanics behind the entry, why the strategy works the way it does. Those things are important for long-term growth of a trader. But then the strategy itself is no secret. The greatest traders have their strategies in the open, right? You might watch a lot of videos about the orb strategy, the opening range breakout. I took a trade the other day, trading the opening range breakout on Nasdaq and New York session. It's a great strategy, very high win rate. Again, if you give an newbie the orb, he understands it perfectly, goes out to trade it. Suppose he stumbles upon a red day. Okay, maybe he can gather his composure, keep together his psychology for a week. Suppose that week that he started trading, produced 3 losses, 2 wins. As you know, losses in certain variations of the orb strategy, losses can be much larger than wins. So that completely shakes their belief, because it's an unprepared psychological state. They come to trading with unprepared psychological state, not out of fault or ignorance, but because you cannot prepare that psychological strength and resilience that trading requires without having spent time trading. So the only way you do that is by actually trading. So even if the strategy works, there's going to be drawdown periods, there's going to be red periods, and you have to know how to survive, not only how to survive that period, but also how to keep your psychology, how to keep your composure, how to not lose trust and sight that this is a probability game, that there's going to be losses and wins, and there are going to be periods where you see very little win, and the big part of succeeding in trading is developing the discipline and the mental strength and resilience to know that you need to survive red periods and without losing trust in your edge. Obviously, if it's been tested and proven to work, like the opening range breakout strategy, which is, by the way, out there in the open. The many great YouTubers who have different variations of the orb strategy they trade with. There's a guy in the future space I quite like, right? Big Daddy Max, as he's called. That's his YouTube channel. He's great. He trades the orb, scalping every breakout of the opening range and trade back into the range as well. Different variations. There's a guy who trades it without a stop loss, dynamic price management, and they all work. They all work. And the thing is, the strategies are out there. What's important is for you to choose a strategy that best suits your trading style, and then make that strategy yours. By that I mean, obviously optimize it, fine tune it to a shape that works for you. Now, I have a whole tool bag of strategies, not just one, that I trade, and I've made each my own. I have compiled even a few strategies together based on my understanding of each, and I've even compiled a couple of strategies together that I trade in non-decision. They're opposite strategies, so I understood that they both worked very frequently on a certain pair, like gold or euro dollar forex pair. So to increase my win rates, I've made those strategies mine. I have fused them together. That has increased my number of entries per session, and also the amount of risk I take per session. But because I fine-tune it so well, it helps me take each entry with a lot of confidence, and I have a lot more signal strength, if you will. What confluences matter, what confluences don't, because their strategies work in opposite to each other, but they work quite frequently. They're quite well, and they're different type of strategies. For example, one is a breakout strategy, one is a momentum strategy. So a breakout strategy has a lower win rate, but quite a high return. You can have 5R, 3R, 7R wins, but would run on a 50%, 45% win rate, which you know is fine if you're having returns like 3R, 5R, 6R, 2R very consistently. I'd say an average of 2.5R return. So if you, because I've fused it with the momentum strategies, a high win rate, lower return like 1.5, 1.7, now they work in harmony. So what I've done is I've taken two strategies. They're not mine, I didn't come up with them, but I've fused them into one that works really intelligently and gives me a very significant edge over the market. So in a nutshell, strategy is out there for free. It doesn't matter what strategy you choose, as long as it's profitable, as long as it's sensible, as long as you risk responsibly. Doesn't matter. What matters is how you make that strategy yours, how you risk manage, how you manage your trades. Very importantly, you can take a trade, you can be right, but if you mismanage it, you can end up losing. I'm sure you've heard the saying, you can be right in the market but lose money, you can be wrong in the market and make money. So after that first candle that took the highs, we had another green candle, but that's a wigless candle. That's a candle without a wig, and I don't like that. If it was a red candle without a wig, I'd like that because I'm in a long trade, not in a short trade. I have a bullish candle without a wig, and I don't like that. So I'll go down to 1 minute, have a look at things. We took these highs, respected this 1 minute channel. As you see, it's an upward channel on the 1 minute chart. So we could expect pullback to this lower line of an upward channel. Maybe as low as this, but if this holds price, acts as a support for it to bounce back, then a trade should be successful. But obviously we can also break this line, change character, go down, stop me out. As with every trade, those are the only two possibilities. Either you lose or you win. There's a third possibility. You're so angry about the fact that you were wrong. So when price comes to these areas, you don't accept the loss. You remove your stop loss. You drag it down. You chase price. It destroys you. You lose the account in one trade. Or while you could have accepted that loss, taken another trade, made the loss amount back, plus a bit of profit. So you can have losing entries. Doesn't matter. A day is not about a single entry. Obviously, there are strategies, there are accounts I trade with that only take one entry per day. And those are high win rate strategies. There's the sort of strategies I don't get an entry every day, so I might go a week without an entry because it does get validated. But if you are trading a multiple entry setup, a first loss entry, take a second entry, but don't rush. When it takes you out, don't rush it. Give yourself a break. Make sure you're reading the chart, not with emotions demanding revenge, but with a bit of reasoning. Of course, the trade is still valid. Like I showed you the 1 minute channel, right? If it respects the 1 minute channel, it's all good. What I'm actually going to do is I'm going to put my TP a little lower than my intended target, and that is because I have gathered a lot of data, right, about what I'm trading. So I have seen lots of times the price does go to my target, but then misses my TP by a few pips, and that is very frustrating when it happens. So there's no logic in wanting $30 more and miss the trade entirely, because if it misses you by a few pips, there's a chance that it completely reverses and falls down and never goes back up towards your target for the duration of your setup. So you've missed on profits just because you wanted a bit more, and especially if it's back tested, it doesn't make any sense for you to try to get a bit more, just a bit more. As expected, we're coming down. There's another red candle printing, and I'm not disappointed by that. I was expecting it. As long as the 1 minute channel holds, it's fine. Okay, there's a double here like that, falling down. If you can hold it in these areas, that's fine. But also, there was another thing that could have happened. This channel could have narrowed down here. You see this red candle? It could have narrowed down, and that narrowed down would mean, whenever you see something like that, would mean that an immediate breakout, an immediate movement, a stronger push to the upside. We didn't have a narrow down. We're coming back to the lower line of an upward channel. So if the line holds, it's a valid trade. I think it will hold. That's my discretionary judgment. But of course it doesn't have to work in such ordinary manner, because it's not a discretionary trade, it's a mechanical setup. And I've seen it do all kind of things, do things that appear to be akin to a change of character, break of structure and all that, but then like come down here and then go up again. What you would traditionally consider a break of structure or change of character. But then there are all sorts of fake outs happening in the market, right? So this is a mechanical strategy. I'm not reading fake outs into it. I don't touch it. As you can see, the pullback stopped here. First try to go up, first factor candle, that would have been my entry. I missed it. I entered at this retest a bit sooner. As you can see, it came down to these lows. I could have entered as low as this, and then we touched the 1 minute channel. So back into the 1 minute channel's lower line again, bounce off of it, back to the line, and we expect to bounce off again. Of course, that can fail. The line can fail to hold. Price can pierce through our lower line of the upward channel. We are in profit. We were in profit. I think halfway, so half of the trade. Yes, we were in profit. 0.8%. Oh yeah, I've talked very little about the risk in this trade. I've risked $300. I'm aiming for $437. Yeah, that's smaller than my usual trades, right? The other day I took a trade, I'm at $1,100, risking around 500. I think it was like 400 something or maybe 500 something. This is a much smaller trade compared to that. It's the beginning of the day here. It's London session, and I have the entire New York session in front of me. And we're going to be trading gold, of course, and also Nasdaq. So I don't want to begin today with a large loss. Even if I lose this trade, it's a $300 loss, and the chances of me making that back from my New York session strategies very quickly is quite positive, even if I lose this trade. If I win it, that's a good foundation for the day, right? As you can see, the 5-minute candle will close in about 24 seconds from now. But then the failure to fill this wick tells me that on the 1 minute chart we might have touched the line. By touch, I don't just mean the wick going down, a candle closing on that line or close to that line. So on the 5 minute we haven't. As you see, failed the wick, went up again, so we haven't touched the line on the 5 minute. On the 1 minute we have, so it could be, yes, on the moment we have, and we have also printed our first fractal candle ready to take off, right? So that's good. The failure to fill that wick on the 5 minute immediately told me that we have done that on the 1 minute. We haven't done on the 5 minute. So either on the 5 minute we'll have a narrow down of channel, a narrow up, it's narrowing upwards, and a breakout, or we're going to have a red candle that will take us to they'll tap into the line on the 5 minute chart. If after this failure to fill that wig we immediately jumped up, that'd be a nice thing, because this whole pullback was a 1 minute fake out on the 1 minute chart, and from the perspective of 5 minutes, we still had a narrow down, a narrow up of structure, and a break to the upside. But that's not what happened. We came back to the line with this candle, not very pleasant body, as you see, large wick, tiny body, but the trade is still valid. On the 1 minute chart, another small candle. It's important to take this high, continue the upward direction. If I've talked in my previous video about something that I've seen so many times in markets, no matter the pair or the product, the instrument, I don't know if I've talked in my videos or not. I talk about something I've seen so many times in the market. This idea of foreseeing the break of structure before it happens. A structure usually breaks when it either narrows up or down. Trend lines break when they narrow up or down. So this is a 1 minute trend line, let's say. It's a 1 minute upward channel, right? Tap once, move away, tap twice. We expect a tap up. But the only way this can break is if we have ranging, if we fail to take these highs and the structure continues to narrow up on the lower line of the upward channel. This is the lower line, that would be the upper line, right, of an upward channel. This is the lower line. So if price lingers around on the lower line of an upward channel, fails to take these highs, and we have an area like this to our left where prices continuously failed to take these highs, the chances that this channel breaks to the downside is very high. It lingers around, the structure narrows down. When I say narrow, of course, the channel is narrowing. You see, if you say this is the upward line of the channel, it's narrowing. It's narrowing. You see, we started off very wide. It starts to narrow. So if price even comes to these highs, fails to take this, that is still a narrowing channel. As you see, it has narrowed down. If it narrows on the lower line of the upward channel, which is this, it's doing it on the line, it can keep on narrowing until it breaks, and it's going to have a large break like this. So that's how structures break. And as I'm talking, explaining this idea of narrowing structures, we see a large push to the upside, which is nice, which means we have hold the line on this lower line of the upward channel, and we are aiming for these highs. And if that happens, so structure has failed to break, so then it wasn't a narrow down, it was just tap into the lower line of the upward channel, and we're moving upwards again. It's very nice. Obviously my mechanical strategy was expecting that, as you see, but that was me explaining the discretionary basis of the trade. So I came out to 5 minute because we're close to TP. Once we hit the TP, I'm going to continue with the explanation of how to understand narrowing structures, how to foresee the break of structure, or even such continuations of structure, by the way. Yeah, I'm going to close it.
Order filled.
Okay. Like I said, it's my first trade for the day. I'm setting a foundation. I have a lot of trades to take, New York session. And that's a nice little trade, as you see. 1.5R. Entry here at this retest. Stop loss here. As you can see, we were barely in drawdown. So just one candle, two candle, we immediately moved up with this one. And then a little bit of weights, tap into the lower channel of the line of the upward channel, a channel identified 1 minute chart, which was the source for back in this trade discretionally if you take it discretionally, and then this large green candle at 9 a.m. London, 9:05, and then this beautiful move into my take profit area. So I'll continue with what I was saying on 1 minute chart, right? So that's how we see narrowing of structure, and that's one way to see it. Obviously, to be prepared for a short, but you're going to have a lot of fake outs. So there's narrowing, and then this break can happen, but it can also be a fake out that obviously is part of the internal movement of a tap back into the line. Whenever you draw your trend lines, your channel lines, they're not going to be perfect. Price is not going to 100% respect them. There are going to be fake outs. There are going to be internal movements outside your lines. Like this could have happened, right? A candle closing here, my line breaking, but still I would not close the trade because yes, it's a mechanical trade and that's why I wouldn't close it, but also because the channel, the line is still valid, right? You see, that is just an internal move. We may think we've tapped into it here, but that is just part of the internal movement. This is not like this. It's an internal movement, all one. And that internal movement, that internal traffic can confuse a new trader if you don't anticipate it, and when it happens, if you don't understand what it is. And as you can see, once it taps into my target, it moves down again very aggressively. So yeah, the other way that the channel breaks is obviously it continues to take the highs, for example, it continues to take this high, and then the channel will linger around here on the upper line of the upward channel. Vice versa, obviously, with a downward channel. It can linger around here like this, right? It can linger around here, range like that, and then suddenly break the upside. And that is a really nice bullish signal, but you don't just enter because it usually happens with large candles. You wait for a retracement, and then you enter with the first fractal candle after that pullback, and then it's a great bullish signal. So those are the two ways channel breaks following what I call narrowing down, right? Very simplistic idea, but very, very consistently happens across all instruments. That's how trend lines break. That's how channels break. I don't know what fancy words you want to use to explain it. That's how channels break. And if you understand that, you consistently see that on the charts, it helps you trading. Even if whatever strategy you trade, it will help you understand what's happening in the market, so it can help you stay in trades that you would otherwise close. For example, if price taps back into these areas and you're long, you may think, oh, it's failing, it's not, no way it's going back up again. But if you understand that the channel is still valid, you might stay in that trade. So whenever I see narrowing channels, right, like this, then I watch those channels for a trade. As you can see, we took this high, right? We take this high, so our upward channel is continuing. I've come back to tap into the lower line of the upward channel. Now here, we'll watch it, whether it breaks a line or whether it respects it, bounce off back. But whenever there's such sudden movement up and down, this is a 1 minute channel, of course, it's a lot more choppier than a 5 minute. But I watch it for before rushing too quickly into taking a buy here towards these highs, because lots of times it rejects here, moves back down as an internal movement. So the move upwards hasn't started yet, possibly. This could all be part of the same move to tap into the line again. So down like this, up like this, You think the move is over, so I'll take a long here to these highs. But then what happens is we tap back into the lower line of the upward channel and then produce a fractal candle and then go up. So that's how understanding channels help you. That's how you can trade inside channels, not just breakouts, but inside channels. If you understand what are internal movements, right? This is an internal movement. I explained this is an internal movement. So you think you take it long here, but then this is just an internal movement. Price rejects an upward movement, falls back, and then gives a fractal candle. But by the time it does that, you probably don't want to take another long because you've taken a loss. You don't trust your judgment of the market. That's what happens to traders, right? You lose so many times based on discretionary reading that you lose trust in your judgment of the market. Even if you take trades, you quickly get out of them because you don't trust yourself reading the market accurately. So when this fractal candle comes, that's a very strong signal to the upside. Following an internal move like this, you take your long, you aim for these highs, for the continuation of channel, bang. But if it fails to go up, it's going to linger on this line like this and then break down. And then you don't take a short, you wait for retracement, first fractal candle, after retracement you take short. This is a very simplistic price action and a simplistic way to trade based on candlesticks and price action. No statistical edge. It's just trading channels and the break of channels. It's easy, and even if you don't trade it, understanding it can help you trading a lot. As you see, the clutter exists on the 1 minute chart. If you go up to the 5 minute chart, it's basically just one red candle. That's just a large candle. But I'm done with this, reading this, because my TP's been heads. My trade was a winner. Obviously, I have my next area of interest for the London session that I might still take another trade. So, which would be above this high. I'll take longs above this high. Aiming for a small trade again. And then shorts below this line. As long as price is within this area, it's a no trade zone for me. After my TP was head, not before that. Now that I've had my winner, it's a no trade zone for me. So that's it for this video. I wanted to show you my first trade of the beginning of this week. It was a winner. Yeah, a nice winner. It's $390 after fees, because apparently you pay quite a bit of hefty fees on pound-dollar pair, trading them as futures on Topstick. When you trade gold and Nasdaq, there's barely any fee, right? I don't think there is any fee. But I've paid $16 worth of fees on this trade. Anyways, yeah, it was a good trade. Again, that's across 5 accounts, so that's 390 times 5. So, although that is small risk, there was a small risk involved in that trade. I was risking 5 accounts at once. So, do the math. That's a nice trade. So yeah, as you can see, price moving back up, probably respecting the 1 minute channel. Again, if you watch this video, obviously you can go back to the London session for the 28th of April. You can study that channel. And this channel is going to break, right? It's not going to stay there forever. It's a 1 minute channel. They break quickly compared to 5 minute, 15 minute, 30 minute. So this channel will break today, possibly today. Well, quite probably today, because it's a 1 minute channel. And then you need to watch how it breaks. Based on what I told you in this video, you can go back, study the break, and see what happens, right? You're going to watch the lower line, the upper line, the way it narrows up or down, and then you're going to call out, you're going to identify fake outs, and you're going to see how it breaks. And if you watch this video, by the time you watch this video, this channel would have broken already. So that's a great way to improve your understanding of simplistic price action, trend lines. Don't just dismiss the trend line as a basic thing. It's just so rudimentary and all that. Every aspect of reading price action is going to help your trading. You don't have to take your trades based on everything you've learned, but it helps you as confluences. It helps you with psychology even. I was talking, this is a very important thing that not a lot of people talk about, right? Suppose you take another setup, but while your setup is ongoing, that can help you stay in that trade, right? Say things go against your way and you are thinking about closing the trade. You close the trade, you find out that it was a winner, you shouldn't have closed it. But if you learn different perspective of looking at the market, reading price action, it can help you stay in a trade, because you can remember how this guy was talking about narrowing channels. Let's not close the trade because I see price respecting that idea, because I see price respecting an upward channel. It's still narrowing. There wasn't a fake out. It still adheres to the channel. Let me go to the 1 minute chart. Let me see this. You'll stay in that trade because you have different ways of reading price action. You now have a deeper understanding of price action. So yeah, I'll end the video here. And if I take trades in the York session, I'll also try to record them and upload them as well. So I'll see you in the next one.